Alright guys, I want to give you a little breakdown here of a trade I took on Friday and give you a little introduction to the options trading strategy known as the straddle. So we got Tesla here inside of a nice consolidation on the hourly charts Friday morning, and you can see that I bought a 262.5 call and I also bought a 262.5 put. So you might be asking yourself, why would I buy a call and a put? Typically, if you think a stock is going to move lower, we're just going to buy a put. If you think it's going to move higher, you're just going to buy a call. But that's one of the tough things about trading, guys, especially with options, is that you need to pick a direction sometimes in order to be correct. So what is really cool about a trade like this, right? Let's take a look here. If you buy options at the correct time inside that consolidation before a move in either direction is made, you don't have to pick the direction. You're buying those options before a move to the upside is made, before a move to the downside is made. And as you guys are going to see here, if the stock simply moves out of that consolidation, whether it's to the upside or whether it's to the downside, the side that's winning is going to pop in value more than the side that's losing and leave you with an overall profit. Now, there's a lot of details in terms of when to put this trade on as far as implied volatility and other things go, but for face value, guys, here's how that trade works. Identify the consolidation, buy an at-the-money call, and buy an at-the-money put at the same time. Then you sit back, and this is where it gets fun. You're just waiting for the stock to make a move out of that tight consolidation. Doesn't matter if it's to the upside, doesn't matter if it's to the downside, you're just looking for a move outside of that consolidation. So let's fast forward a little bit here and I'll show you what happened with Tesla and what that P&L looked like. Alright guys, so a few minutes later here and we got what we're looking for. Weren't really necessarily looking for a move to the downside, but again, just looking for Tesla to move out of that hourly squeeze consolidation. So now it's finally making that move here, and you can see I'm up $600+ on the calls, the puts that I bought. I'm down $370 on the calls that I bought. In between the two, I'm up $230. Now, fast forward here a little bit and Tesla continued to drop, and you're going to see that P&L be reflected right there. You're buying two options inside of that consolidation, and then when that move finally takes place, upside, downside, whatever it may be, not only is the option that is, going in the right direction, gaining value simply from that, but the implied volatility can also begin to spike. And that's when that option kind of begins to gain value from a double whammy, if you want to call it. So take a pause right now, guys, and take a look. You're up $650 on the puts you bought. You're down $380 on the calls that you bought. And you're up about $270. So let's go to the end of this trade now. All right, guys, now a few minutes later, and now Tesla is really beginning to drop here. And you can see, the puts that I bought are really starting to gain value. They're spiking in implied volatility, and I'm up about $300+ now between those two options. So at this point, that's when I went and closed that trade, took that profit off the table. But let's talk about this trade and, the thought process behind it a little bit more. So the straddle, guys, it's just an example of one of those higher probability options trading strategies where you don't have to pick a direction the stock is going to make, rather you're just exploiting how the options themselves actually work. So if you think about it, during that consolidation, before the stock moves to the upside or the downside, options on both sides of the chain are what we could call quiet. Neither side is really gaining value and neither side is spiking in implied volatility. And we know from trading these consolidation trades every day that the big moves tend to take place when those squeezes finally break. So when you can identify the squeeze, like I did there in Tesla, you buy a call and you buy a put when they're both quiet before either side is gaining, heat, so to say, you're perfectly positioned now. You don't have to pick a direction. You don't have to be right. You just need a move out of that consolidation, whether it's up or down, to take place. Now, the side that works in your favor, in the case here for Tesla, it was obviously the puts. They're going to gain value simply because the stock is falling, but think about implied volatility, guys. And we're going to talk more about this, in a few upcoming lessons. When the implied volatility spikes, your option is also gaining value from that as well. So the side that works gets what you can call like that double whammy, and that's what leaves you with a profit overall. So I'm really a big fan of these higher probability, lower stress ways of trading options where I don't have to be right, and it just leaves me with a better chance to, actually profit should that stock move, really regardless of which way it goes. So more videos like this to come, guys. I hope you enjoyed this. I hope you're enjoying your weekend. And if you want to learn more about options trading strategies like the straddle, click the link in the bio, free 10-day trial to the Focus Trades group, and I hope to see you guys in there. Be back to you soon. Enjoy your weekend, guys.